tell me, in the market, investors will start selling these ETFs. What will happen to your ETF value? This is not difficult. Understand this. You purchase an ETF where you have shares of company A, B, and C. Right? And this ETF, many other investors will start selling in the market. What will happen to your ETF value? Your ETF value will decrease. That's the basic idea. It will decrease. And you have an ETF, and in the market, people, that is investors, want to purchase, right? Right, these types of ETFs in the market. Demand becomes very high. So in that case, what will happen to your ETF value? Your ETF value will start increasing. Basic idea, nothing is changing. Please understand, do not complicate the model of ETF. Please do not complicate it. Just like you purchase share, you will purchase group of shares, that is ETF. Just like you purchase a bond, you will purchase group of bonds, that is ETF. And when the selling of the shares increases, market price will go down. Apply the same logic to an ETF also. If ETF selling increases, ETF value will go down. So can I simply say ETF prices will keep on fluctuating in the market? I hope you understand. ETF prices will fluctuate in the market. Done. So ETFs are tradable. The prices will keep on varying. And what is the advantage of ETF? ETF will provide a diversified portfolio. ETF will provide a diversified portfolio. Done. Any difficulty here? Please do not complicate these things. Keep it always simple. Keep it always simple. Do not complicate it. Okay? Can we go forward now? Now, some of you are saying, sir, today's class is economics class or share market class. My dear, don't start criticizing like that. Don't start criticizing. I'll tell you why I'm discussing all of these concepts. It is very easy to jump gun and start scolding, abusing faculty, etc. Have you heard of CPSE ETF? Let me know. Have you heard of CPSE ETF? No. Why? It is basically ETF of government shares of government companies. Don't you think that kind of a question can be asked in UPSC? Point number 2. Have you heard of term disinvestment? Let me know. Have you heard of the term disinvestment? If you say no, then I'll simply ask, look at the day for yesterday's lecture. Can I say, think of this now. Can I say one of the methods used by the government to go for disinvestment can be through ETF? Think of it now. Please think of it. Can I say one of the methods that government of India can go for disinvestment is through ETF? Arey Baba, please think carefully. Think carefully before jumping and saying, no way, I have not read it, I have not come across it. Sir, what do you mean by that? Imagine there are 3 public sector companies ABC. Imagine there are 3 public sector companies ABC. Public sector means what? Owned by government of India. Can government of India take shares of all the 3 companies, create an ETF, sell it in the market? Think of it. Can government of India take the shares of ABC, club it together, sell it in the market? Of course, yes. Can government of India do that for bonds as well? Think of it. Can government of India do this for bonds? Of course, yes, they are doing it now. That is the current affairs. Right? If you have not heard of it, please hear it now. Bharat Bond ETF. That is very famous now. So let's start. So CPSE ETF, Bharat 22 ETF. Okay. So CPSE ETF, Bharat 22 ETF. Now, please understand, ETFs, multiple ETFs are there in Indian market. I repeat, multiple ETFs are there in Indian market. You don't worry, there are more than 100 ETFs. I repeat, there are more than 100 ETFs in India. Don't worry about all of it. Understand how it is connected to government. What can be the potential question asked here? That's more than sufficient. Now, there is one question. Can there be a ETF with a combination of bond and a share? My dear, if you have a combination of bonds and shares, in which market will you list out the ETF? Please do let me know. In which market will you list out the ETF? Please do let me know. because right, ETF has to be listed. It has to be listed in either the share market or in the bond market. Where will you list it out? Listing is not possible, and that is the reason generally there are other types of mutual funds, right, which will offer you this kind of a combination. And before going forward, there were two students who asked, both mutual funds as well as ETF look similar. Both are one and the same. No, both are not one and the same. There is a difference between both of them. Remember this point. In case of ETF, these are called as passively managed. You'll understand in a minute. Just give me a minute. These are called as passively managed investments. Whereas in case of mutual funds, these are called as actively managed investments. Actively managed investment. So what do you mean by that? Let me give a very simple example. Imagine you'll purchase this equity ETF. Imagine you'll purchase this equity ETF. Please tell me, can you change the composition of assets in this? Please think of it and answer. Imagine you purchase this equity ETF, which is there right in front of you. Can you change the composition of assets here? Can you change the composition? No, you cannot change the composition. It's a packet. It's a jumps packet. Either purchase the complete packet or sell the complete packet. You cannot alter the composition. But on the other side, in case of a mutual fund company, imagine a mutual fund company is there, right? That is, I will collect 300 rupees from you. I'll purchase a share of A, B, and C today. Please tell me, can I change the asset composition tomorrow? Right? Let me know. Can I change the composition of asset? Of course, yes. That is, the asset management company can keep on changing it. Tomorrow I can sell B and C and purchase only A. Day after tomorrow I'll sell A also, I'll purchase D share. So that is called as actively managed investments. Active investments. Whereas in case of ETF, no, right? You cannot change the composition of assets. Composition of assets in ETF will always remain same. Either you can purchase the whole composition or you can sell the complete composition. You cannot alter the composition of assets within ETF. So ETF are passively managed, MF are actively managed. Okay, now let me go to the next point here. CPSE ETF. CPSE ETF. Now there are two types of ETF related to Government of India. Government of India. CPSE ETF and Bharat 22 ETF. Now think of this. If I say the ETFs will consist of shares, can I call this as equity ETFs? Please do let me know. When I say the ETF will consist of shares, can I call this as equity ETF? So related to Government of India, there are two equity ETFs. One is CPSE ETF, second one is Bharat 22 ETF. CPSE ETF was launched in 2014, and in this ETF, there are 12 shares. There are 12 shares, that is shares of 12 companies, right? Shares of 12 CPSEs. Now, if you purchase this 1 unit of CPSE ETF, can I say you are purchasing shares in 12 companies? Yes or no? Does it make sense to you? If you purchase, right, 1 unit of this CPSE ETF, can I say you have invested in the shares of 12 companies? Of course, yes. Now, Government of India cannot manage all of these assets. Assets means if new CPSE ETFs have to be issued, money has to be collected by the investors, right? Where the money is being spent, etc. Government doesn't do it. Government will appoint an asset management company. And the asset management company for this CPSE ETF is Reliance AMC. It is Reliance AMC. Now it is Nippon AMC, right? Reliance Nippon Asset Management Company. So this is CPSE ETF. Next one is Bharat 22 ETF. At Bharat 22 ETF, it was launched in 2017. It will bring the shares from 6 sectors. How many companies? 22 companies from 6 right sectors. So basically, Bharat 22 ETF was launched in 2017, and it comprises right shares from companies which are there from the 6 sectors, and this is managed by ICICI Prudential AMC, right? AMC,
Bharati
ICICI Prudential AMC.
ಮಾತು
Done. So these are
আমাদের দিক
equity
দিয়ে ঘোরাঘুরি
ETF.
করতেছে তো
UPSC can ask a question regarding ETF. Please be very careful. So far, it has not been asked. Trust me, so far, no question has been asked on ETF. But in recent times, ETFs are becoming very, very famous. UPSC can ask a question on it. Now, there is a Bharat Bond ETF. What is a Bharat Bond ETF? Look at the term bond and can I basically say this is a debt ETF? Let me know. Bharat Bond ETF, can I say this is a debt ETF? Bond means a debt. Right? Bharat Bond ETF. This has been launched by government very recently, couple of years ago. What is the logic of Bharat Bond ETF? Please understand this. Imagine there is a, right? There are two public sector companies, A and B. There are two public sector companies, understand this, A and B. A company has issued a bond in 20, right? 20. Let's say maturity period of 5 years. And it has issued one more set of bonds in 2020 with a maturity period of 3 years. Let's say company B has issued one bond in 2021 with a maturity period of 2 years and also has issued one more set of bonds in 2021 with a maturity period of 4 years. Now please think of it. When will this bond mature? It will mature in 2025. When will this bond mature? It will mature in 2023. When will this mature? It will mature in 2023. And when will this mature? 2025. Now please think of it and let me know. Can I club these two bonds and call it as ETF 2023? Let me know. Can I club? Club means can I take bond of company A, bond of company B, which are going to mature in 2023? Can I call it as ETF 2023? Yes, this is how these bonds are clubbed together. Now look at, right, maturities of ETFs. It should not be difficult now. Look at maturities of ETF. There are 5 types. I've written only 4 types. There are 5 types of maturities of equity, bond, the ETFs here, Bharat Bond ETFs. So 2023, which means there are bonds of government companies, public sector companies, all of them will mature in 23. They could have been issued any year, but all of them will mature in 23. We have another maturity 24. Another, right, the debt ETF, where all the bonds of public sector companies will mature in 24. Same for 30, same for 31 as well. Right, just to make it much more clear, let me know, can I club this bond with this bond? Can I club both of these bonds and call it as a ETF 2025 now? Of course, yes. Call them as a ETF 2025. Of course, yes, they might have been issued in different years, but all of them will mature in the same year. This is basically the concept of Bharat Bond ETF. Bharat Bond ETF has a fixed maturity period, right? That is, right, 2023, 2025, 2030, 2031, 2033, etc. like this. Why do we have these kinds of maturity period? Government of India says, if you want to invest in government bonds again, not literally issued by government, issued by government companies, not issued by government of India, issued by government companies. You want to invest for a shorter duration, there is a ETF 2023 for you. You want to invest in a longer duration, right? That will be 2031. I hope you understand, right? You can choose either 2031, you can choose 2030, or you can choose 2025 or 23 based on your requirement. Right? We have different types of ETFs. You choose where you want to invest. It will invest in high quality triple A rated. Please tell me, do you understand what is meaning of triple A rated now? It will invest in high quality triple A rated bonds of public sector companies. It will hold the bonds till their maturity. Coupons are not given annually. Coupons are again reinvested. Once the bonds will mature, along with the coupon, plus interest on the coupon, plus, that is, returns on the coupon, plus your principal amount will be repaid. This is how Bharat Bond ETF will actually work out. The fund will be managed by Edelweiss, a mutual fund company. This is the asset management company. right? We have multiple maturities. For example, we have maturities of 23, 24, 30, 31, etc. Any problem with bond ETF as well as a debt ETF? Can we go forward here? Means according to maturity of the bond period is decided the year, right? If you come across Bharat bond ETF, let's say 2035, let me know. If you come across Bharat bond ETF 2035, what does it mean? It simply means whatever bonds of companies are there, CPSE bonds are there in this ETF 35, all of them will mature in 2035. I hope you understand. All of them will mature in 2035. When they are issued, that's not important. But all of them will mature in 2035. But how can we differentiate which one is debt ETF, which one is equity ETF? My dear, in Bombay Stock Exchange, sorry, in National Stock Exchange, imagine you will come across CPSE ETF. Please tell me, is it a debt ETF or an equity ETF? Let me know. You tell me the answer. You will read the newspaper, they'll say in NSE, there is CPSE ETF. Is it right a bond ETF or an equity? It's a stock market. In case of stock market, it has to be equity ETF. In the bond market, you will come across a debt ETF. So where they are listed, right? In which market they are listed, don't you think based on that you'll be able to differentiate whether this is equity or a debt? If that is also difficult, right, please do me a favor. If you want, you can visit Nippon, right? Nippon Mutual Fund website, Nippon AMC website. They have listed, right, these kinds of ETFs, and they will tell you. They will clearly say, okay, this is a debt ETF, this is a equity ETF. And when you're investing, don't you think you should check all of it and make investment later? So it is very clear whether this is equity or debt. Based on that, you can make a decision. Okay. It will hold the bonds till maturity. That is, if this is right ETF 2035, imagine you have purchased ETF 2035. The company which has purchased your money will hold your money till 2035. They will not return anything to you till 2035. But within this ETF 2035, there are bonds. There are bonds. Bonds will have coupon rate. Sir, will I get annual coupon rate? Government says no, you will not get annual coupon rate also. Coupon, right, that is, let's say 10 rupee coupon will be again reinvested. Again reinvested. You will not get the coupon rate. It will be again reinvested in the bond ETF, and upon maturity, complete returns will be given to you. Right, that is basically the point number 3. Okay, the fund managing asset management will be done by Edelweiss Mutual Fund Company. Okay, right. So this is basically the idea of a Bharat bond ETF. So this is a equity ETF and debt ETF, very famous now. New type of investment strategy being promoted by Government of India, SEBI, etc. Please be very careful. Questions so far has not been asked. Now let me go to the next one. What are the issues? What are the issues in the corporate bond market? What are the problems in the corporate bond market? Generally, you will come across this argument for corporate bond market. The argument is the corporate bond market in India is not very well developed. Let me know whether you've come across this statement in the newspapers or not. The corporate bond market in India is not very well developed, or else they will simply say corporate bond market is not mature enough in India. It is not mature enough in India. Now, what is this problem with the corporate bond market? And please think of this. Earlier also I've told you regarding this. Don't tell me, sir, you have never used the term corporate bond is not developed in India. I'll tell you the context also. Please do let me know. One of the methods through which NABFID will raise money is by issuing bonds. Do you remember this? Last week. Not this week, but last week. One of the methods through which NABFID will raise money is through by issuing bonds. And one of the problems I've written regarding NABFID model was the corporate bond market is not very well developed. So now we have to wait and see how much money will be raised by NABFID by issuing bonds. right? If it is, if you don't remember it, please open NABFID banking chapter, NABFID, go to the concerns or issues. I've written the term bond market is not very well developed in India. Bond market is not very well developed. Now, what is the issue? Why corporate bond market is not very well developed in India? We'll go point by one, point by point. Please understand this. First one is, most of the bond market, most of the instruments in the bond market are basically government bonds. I'll repeat the statement here again. Please understand this. Most of the instruments in the bond market, government can issue bonds, corporate sector also can issue bonds. But most of the values of the bonds in the bond market are basically government bonds. It could be central government bond, it could be even state government bond. But more than 70%, I repeat, more than 70% value in the bond market is government bonds itself. Which also means, right, look at the other side of it, only around 30%. Again, do not by heart this number. From 1 year to the next year, numbers will keep on changing. Around 30% of the total bond value in India are from private sector. Yes or no? Please do correct me. If more than 70% of the bonds issued in India are government bonds, does it also mean around 30% of it are basically corporate sector, that is private sector bond? This is generally the situation in case of India. This is the situation in case of India. Whereas in the foreign countries, such as USA, the private sector, the value of bonds issued by the private sector is higher compared to value of the bonds issued by the government. Right? So in case of India, most of it is government bonds, very small value of corporate, whereas the opposite in case of developed countries. Why, you will understand in a minute. Second one is, there is a illiquid secondary market. There is a illiquid secondary market. Now, what do you mean by illiquid secondary market? Let me explain it to you. Imagine you will purchase this instrument. Imagine you will purchase this instrument directly from the issuer. I will repeat the statement. Imagine you will purchase this instrument directly from the issuer. Can I say this is primary market? Let me know. Imagine you'll purchase this instrument directly from the issuer. Can I say this is primary market? Yes, it's a primary market. Now, what if I say there is no much demand for this in the secondary market? Think of it, right? Second point is, I am telling you, not much demand is there. Not many buyers will come to purchase this instrument from you in the secondary market. If this is the situation, please tell me, will you demand for such instrument in the primary market? Let me know. Will you demand for such instruments even in the primary market? No. Why? You will not demand it. Please think of it. You will not demand it. Why? If there is no demand for these instruments in the secondary market, why do you think people or investors will purchase those instruments in the primary market? So remember this, secondary market for government bonds is very famous in India. I'll repeat the statement. Secondary market for government bonds is very well developed, very liquid. Investors are demanding more of government bonds. Sellers are selling government bonds. So there is a high liquidity for secondary market, for government bonds in the secondary market. But in case of corporate bonds, private sector bonds, demand in the secondary market is very weak. And the reason the demand is very weak is, between government and private sector, don't you think government bonds will carry more safety features? Think of it. Government bonds will carry more safety features. Investors will have more confidence on government bonds compared to private sector bonds. That is the reason, because secondary market is not very well developed. Demand for these instruments in the secondary market is very less. Hence, the demand in the primary market will also be very lesser. Can I go forward now? Any issue with this? Third one, very narrow investor base. Very narrow investor base. Meaning what? Investors within the corporate bond market, investors within the corporate bonds are also very few. Mainly the investors in the corporate bond market are financial institutions. Individuals generally, I repeat, individuals generally do not prefer to invest in corporate bonds. They prefer to invest either in the government bond or they prefer to invest in the stock market. Yes or no? Please do let me know. Investors, especially individual investors, and first and foremost, please remember this. Unlike Western markets, individual participation in the financial market in India is very low. I'll repeat the statement. Unlike Western markets, individual participation, that is retail investor participation in the financial market is very low. And within that also, many of the investors will focus on equity market, because argument is simple. In equity market, risk is very high, but returns are also very high. Correct or not? If you make correct returns, risk is very high, no doubt. But if you play it very correctly, right, returns will also be very high. Everybody wants to become Rakesh Jhunjhunwala. Everybody wants to become Mr. Harshad Mehta, right, where they want to make huge amount of money within a very, very short time period. So that is the reason. Point number one, please remember this. Retail investor participation in India is very low, right? Hardly around 3 to 4%. And within that also, lot of these investors, if they want to play safe, they will choose government bonds, or if they want to earn higher returns, they will choose equity market. That is a narrow investor base. Narrow means a very, very small investor base who are actually interested in corporate bonds. Lack of repo operations. Do you remember repo and reverse repo? Please do tell me. In a repo operations, what kind of collateral is used? What is the security used in repo operations? Can I say government securities? Correct? Can I say government securities? Government securities are mainly used in repo operations. So even when the repo operations or reverse repo operations are conducted, which are done on day-to-day basis, mind you, in terms of thousands of crores of rupees, it is mainly the government securities which are used. Corporate securities are not accepted. So if you talk about a bank, if they want to purchase a corporate bond, they are not allowed to use corporate bond in a repo operation. So tell me, will the bank demand more of corporate bonds in the market? No, the preference for government securities would be much higher. And finally, different types of bonds, right? Diversity in the bonds, different types of bonds, right? Different diversity of the bonds is not very well developed in India. Very few types of bonds are there in India compared to Western markets. Compared to Western markets, very, very few types. Some of you might simply start accusing me and say, sir, masala bond is there. But sir, green bond is there. My dear, green bonds, masala bonds have become famous only in the last decade. I hope you understand my statement. The concept of a green bond, masala bond, additional tier 1 bond, tier 2 bond, etc., have become very famous in the last 1 decade. Right, but the bond market is not open in last 1 decade. It is a very, very old bond market in India. So argument is very simple. Different types of bonds will have to be developed, have to be promoted in India, so that investors' confidence in the bond market will improve, that participation in the bond market will start increasing. So these are certain very important reasons why corporate bond market is not very well developed. Right? Why corporate bond market in India is not very well developed, whereas a government bond market is very well developed. Can we go forward? Can we go forward? Arey Baba, I'll repeat all the points once again, but listen carefully. If you don't listen to the points carefully, there is no point in running around the bush again and again. There's no point. Point number one. Most of the bonds in the bond market in India are government bonds. Most of the bonds, more than 70% of value of the bonds in the bond market is government bond. So very less of corporate bonds are issued in India. Point number two, the demand, right? That is the trading, demand and supply. The trading of these corporate bonds in the secondary market is not very high, right? There is very less demand for corporate bond markets even in the secondary market. Because compared to corporate bonds, in case of India, investors feel more secure to invest in government bonds. That is the reason even in the secondary market, trading volumes are very, very low, illiquid secondary market. Third one is investor base is very narrow. Narrow means very little. Right? Most of the investors in India prefer to invest in government bonds or in the equity market. Corporate bonds, the preference is very, very low. Fourth point, right? These corporate bonds cannot be used even in case of repo operations. So if you talk about a repo operation, government securities are used as a collateral, right? As a security in the repo operation. So even for a bank, demand for right the government bonds is higher compared to corporate bonds. And we do not have different types of varieties of bonds in India. The variety that is available in India is much, much lower compared to the foreign Western markets. So we need to develop and promote new types of bonds so that it will attract a lot of investors. Confidence of the investors in the market will increase. Liquidity will also increase in the bond market. Done. So these are some of the reasons why corporate bond market in India is not very well developed. Now, what is the reform? What kind of reforms have been implemented? First one, Reserve Bank of India as well as Government of India are promoting new types of bonds in India. They are promoting newer, right, new types of bonds in India. For example, green bonds. Please tell me, did we discuss all these bonds? If there is anyone who says, sir, you have not discussed this particular bond, let me know. I will tell you in which chapter I have discussed. I'll tell you where I have discussed. Masala bonds? Yes. AT1 bonds? Yes. Tier 2 bonds? Also? Yes. All these bonds, these are new types of bonds in India. In fact, now there is one more type of a bond, infrastructure bonds. Again, new type of bond in the sense now the demand is actually increasing. Infrastructure bonds. Have you come across the term infrastructure bond? Please do let me know. Have you come across infrastructure bond? Let me see how many of you have read the newspapers. Let me see how many of you have read the newspapers. I'll tell you. Right, so infrastructure bonds are being issued by State Bank of India now. If you have not read it, please read it. Infrastructure bonds are issued by State Bank of India now. Right, last week they have issued. Again, they want to issue infrastructure bonds. Right, SBI has issued infrastructure bonds of tenure 15 years. 15 years. Because please remember, point number one, please let me know. Infrastructure means what? Should the bond have a lower maturity period, let's say 2 to 3 years, or a longer maturity period? Think of it and please do let me know. If there is anyone issuing an infrastructure bond to you and they're borrowing, what do you think should be the maturity period? Right, 2 years, 3 years, 5 years, or 10 years, 12 years, 15 years? It should be longer time period. That is the reason RBI simply says, if you are going to issue infrastructure bond, it should have a maturity period of at least 7 years. It should have a maturity period of at least 7 years. You cannot issue below 7 years. Why? Infrastructure requires right long-term borrowing. You cannot repay it in short term. It will put a lot of pressure on you. Long-term borrowing. So that is the reason now infrastructure bonds are very famous. Check it in Google, you will understand it. SBI has issued a 10,000 crore worth of infrastructure bonds a couple of days ago. Now they want to further issue another 10,000 crore worth of infrastructure bonds. So promotion of a newer types of bonds is being done here. Second one is a targeted long-term repo operations. TLTRO. TLTRO. Targeted long-term repo operations. Now, what do you mean by targeted long-term repo operations? Let me explain this. Here is a bank, and the bank will take a loan for 1 to 3 years. 1 to 3 years from Reserve Bank of India. Look at the term long term, targeted long term. So bank will take a loan for 1 to 3 years from Reserve Bank of India and use it to purchase only corporate bonds. Look at the sequence here. I'll repeat it. Right, under RBI, this particular facility is provided now. Right, the bank will take loan for 1 to 3 years and use this money to purchase only corporate bonds in the market. Now, is it okay if I say this is a targeted operation? Let me know. This is a targeted, right? Measure. Targeted means what? We are going to use the money only for purchasing corporate bond. Point number 2. Whenever the bank will use this facility to purchase corporate bond, what kind of corporate bond they are allowed to purchase? Should they purchase a junk grade? Should they purchase an investment grade? RBI simply says you will not be allowed to purchase a junk grade. You will be allowed to purchase only investment grade bonds. Only investment grade, not the junk grade, because the junk grade is very risky. Right? Do not take a loan from me and purchase a risky instruments in the market. Better purchase, right? Better, safer investments or higher safety instruments. That is investment grade. Any credit rating of BBB or above BBB. Now, instead of BBB, can UPSC confuse you by writing Baa3? Let me know. Right? Instead of BBB, can UPSC confuse you? Because most of you will by heart everything. Instead of BBB, can UPSC confuse you by writing any bond with a credit rating of equivalent to or above Baa3? Of course, yes. That is also, right, investment grade. So Baa3 and above that, that is also investment grade. So for some of the agency, it is only alphabet. For some of the agency, it is a combination of alphabet and numbers. Okay. So RBI says you can take a loan under this facility for a duration 1 to 3 years and I'll charge you repo rate. I will charge you repo rate of interest on it and you can use it. You can use it to purchase only investment grade corporate bonds. Only investment grade corporate bonds. Now please tell me, using this tool, is RBI trying to improve, I repeat, is RBI trying to improve liquidity for corporate bond market? Let me know, right? Does it make sense to you or not? Using this, is RBI trying to improve liquidity for corporate bond market or not? Of course, yes. So these are some of the measures which are being undertaken by the government as well as the Reserve Bank of India in recent times to promote a bond market in India. Done? So that's the end of the chapter for you people. Next is the questions. If anybody has got any kind of a doubt, please do let me know. Otherwise, I'll go forward with questions. We'll solve the questions. Then we'll go back to the next chapter. Kindly explain. I don't understand what is meant by equivalent terms in I. Okay, Baba. If I say ECB, the limit is $1. If I say ECB, limit is $1 and exchange rate is $1 is equal to 50 rupees, can I say equivalent value of borrowing under ECB will be equal to 50 rupees? Those who are asking the question, answer it. If you do not answer it, I'll not pick up your questions henceforth. I'll repeat it. Your question is, you have written under ECB equivalent rupee. What is the meaning of it? Please tell me, if the limit is $1 and exchange rate is $1 is equal to 50, can I borrow 50 rupee by issuing masala bond and say I have reached ECB limit? That's the argument. Equivalent value in rupees. That's the argument. What is the difference between BBB and Baa3? My dear, please, right? Please look at the table. Couple of agencies will give triple alphabets and couple of agencies will give in, right, Baa3, Baa2 like this. If you are listening to the lecture carefully, all of these will not be a problem for you. Long-term repo operation, bank will borrow from RBI. I repeat, bank will borrow from RBI and use it for investment purposes. Right? This is targeted long-term repo operation. Can long-term repo targeted, can TLTRO be used for housing loan? No, they can be used only to purchase corporate bonds. What is meaning of masala bond? My dear, revise. Don't keep on. If we are covering it right in the last 2 days, you are asking me today. Then what are you revising? Let me ask you that question. What are you revising then? Did we not discuss the concept of masala bond day before yesterday? In case of masala bond, an Indian company will go outside India. Not even day before yesterday. Yesterday. Indian company will go outside India, issue bonds, and collect the investment in domestic currency. That is
পলাশ
rupees. They will collect the money in form of a domestic currency and repay again in domestic currency. Okay. Can you provide more information about infrastructure? No? Read newspapers. No? Please read
কেন
newspapers.
পলাশের ওই যে
Right?
ভাস্তার
Again, I hope you understand.
বাচ্চা কাচ্চা
My grievance with the students is that you want me to read everything. You do not want to read anything. Let me know. This is your argument. You want me to read everything. You don't want to read anything. How? Am I writing the exam? Let me know. If I'm writing the exam, that is my duty.
নিচে যেহেতু দেখে
After the classes are over, what will you do then? After the classes are over, what will you do? Is it not your duty to read? Hey, Baba, read. Right? Please read. How market is affected in India when there is downgrading of USA? If there's a downgrading of USA, interest rates in USA will start increasing, yield rates will start increasing. As a result of this, investments from India will move to USA. This is called as a capital flight. And when investments from India will move to USA, that will mean, right, they are selling the instruments in India, sales will increase, supply will increase, right, the market prices of shares will fall down. And that is the precise reason, the stock market, when the downgrading happened, the stock market actually took a hit in India. Okay. T holds the bonds until their maturity and reinvest the coupons received. Arey Baba, the company, the asset management company will not give you any returns until the maturity is over. They will keep, right, the coupon also, they'll keep the principal also, they'll keep on investing and give you returns after the maturity period is over. Okay. But isn't lack of trust in corporate bonds help government bonds, as demand for government bonds will be increased? I've explained the same thing. Right, because investors feel more secure with the government of India bonds or state government bonds, a demand for the government bonds would be higher. Safety is very high. Bonds and debentures are same than in India. Debenture is also developed like bonds. Again, I am saying the term bond and debenture in many countries there is absolutely no difference. They use them interchangeably. They will use them interchangeably. Okay. If group of persons are selling some securities means it will consequently reduce the price of the security in the securities market. But my question is, if one person is selling the security, that means there is another person buying the security. So how it will reduce the price of the security? My dear, if you are a buyer, think of it. If you are a buyer, there are 100 sellers who will come to you and try to sell the security to you. And now you are seeing that in the economy. Now you are seeing it in the market. Will you purchase the security at a higher price or a lower price? Think of it. Please apply common sense. You know that foreign investors will start jumping from India. They will go to USA. You know that now. Right? Because that is what actually happens. Now you know that. Now if they want to sell it to you, will you purchase it at a higher price or a lower price? You'll basically say, I will buy it at only this much price. So don't you think overall in the market prices should drop down? That is exactly what happens. Sir, but in Grow Up it allows direct investment. Yes, there are various instruments which will allow you to make a direct investment. That is also available. What is the issue? Why don't? Okay, I've addressed all of this. Okay, let me take up questions now. Earlier, descriptive questions were left out from the fiscal policy chapter. Okay. The descriptive question from the fiscal policy were left out. Let me explain it today. The public expenditure management is a challenge to government of India in the context of budget making during the post-liberalization period. Clarified. Right? Why budget making is a challenge in India post-liberalization? Post-liberalization means post-1991. Simple. After 1991, budget making has become difficult for government of India. It's a difficult exercise. How? Please explain it. Now, please understand, post 1991, why do we say budget making exercise is difficult? Let me explain it. First one, it is very difficult for the government of India. It has become very difficult for government of India to control fiscal deficit. How so? Let me explain it. Follow this very carefully. Government of India's requirement for expenditure on one side has increased. Requirement of expenditure has increased, no doubt. It is higher now. But on the other side, there is a challenge. What is the challenge? If government of India will start spending more money on welfare as well as let's say other development projects, they will have to borrow more money. And when they want to borrow more money, the fiscal deficit will start increasing. And let me connect one more point here. Look at the third point. Global shocks can also add to the pressures of fiscal deficit for government of India. Let me explain this. Follow this very carefully. In case of India, fertilizers are provided at subsidized prices. Everybody knows this? If you do not know, please read today's newspaper, Hindu newspaper. There is a standing committee, standing parliamentary panel recommendation regarding providing fertilizers itself. Today's Hindu newspaper, please read it. Right, there is a very nice article. By the way, today's Hindu newspaper, if you ask me, sir, which articles should we read? There is one article on fertilizer, right? There's a standing committee report on fertilizer. Read it. Central page article, that is editorial on government policies. Please read it. Right, when I discuss industrial policy, I'll simply say whenever government policy, they will change it abruptly like this, that will affect investment. You should not ask me why. Do you understand what I'm trying to tell you now? Today is a newspaper. It is your duty. Don't tell me that it is not my duty. I will not read newspaper. What will you do? Then I'll simply say all the best for UPSC examination. So it is your duty to read newspapers. Read today's the editorial. First editorial itself is regarding government policies. And whenever government policies will be abruptly changed like this, it will have a huge impact on many other policies, many other investments in the economy. They have proved it. Please read that article. So that is one. Second one is fertilizers. Third one is China has entered into deflation now. How many of you remember the term deflation? China has fallen into deflation now. How many of you remember the term deflation? Sir, where did you teach it? Where did I come across it? My dear, look at inflation. Please look at the chapter of inflation. There's a concept called as a deflation. In fact, I gave you difference between disinflation as well as a deflation. Disinflation as well as deflation. Deflation means prices will reduce. Prices will reduce, a negative rate of inflation. Chinese economy for the month of July has registered minus 0.3. Minus 0.3. Price levels have fallen by 0.3 year on year. That is the reason we are saying China's deflation. Do you think deflation is good for economy? Think of it. Do you think deflation is good for the economy? Deflation represent. Don't you think deflation represents a lower demand for goods and services? I hope you understand this, right? Deflation represents lower demand. The demand for goods and services is reducing. That is not good. That is not good. When inflation is there, demand should go down. But when there is a deflation, the demand becomes very, very low. Now tell me, what is the duty of the government then? Don't you think the duty of the government will be to provide fiscal stimulus? Let me know. Now the duty of the government will be to provide fiscal stimulus. That is being discussed in that article. Please read it. So Chinese deflation. Second one is the fertilizer. Third one is the argument of the editorial. Please read all the three. Okay. I hope you are reading it. Otherwise, every day I'll keep on telling you the list from Hindu newspaper. If you don't read it, then the whole exercise is futile. Whole exercise is useless, futile. Now, come to this here. Let me connect point number 1 and point number 3. Challenges of globalization. How supply shock will create problems for fiscal deficit for Government of India. Government of India provides subsidies for fertilizer. Means the actual cost of the fertilizer is very high. But by government providing money the incentive for the manufacturer, subsidies for the manufacturer,
ना
they are able to sell it to customers, that is the buyers,
Number
farmers
one
in the market at a lower price.
ठीक है
Now, please understand
Hazır,
this.
hazır.
Because of Russia-Ukraine war, because of Russia-Ukraine war, what happened to gas prices? What would happen to gas prices? Gas prices will start increasing. What will happen to nitrogen prices? What will happen to raw material prices? All the prices will start increasing. Now, please tell me, as a result of this, what should happen to cost of producing fertilizer? That should also start increasing. Now, if fertilizer prices will start increasing and these sellers will sell it at a higher price to farmers, do you think farmers will be able to, one, purchase fertilizers? Think of it. Do you think farmers will be able to purchase? No. Even if they purchase, think of it, even if they purchase, what do you think will happen to cost of production, subsequently market prices, subsequently food inflation? I hope you understand the connection of dots here. Food inflation will start increasing. So in order to control food inflation, in order to ensure fertilizers are available at affordable prices to the farmers, government will provide subsidies. Now, if government will provide subsidies, what will happen to fiscal deficit? What will happen to revenue deficit? Don't you think those will become a challenge for government of India? All of you okay with it? Those will become challenges for government of India. Second one is crowding effect. What do you mean by crowding effect here? Understand this carefully. If government of India's borrowings will increase, if government of India's borrowings, that is fiscal deficit will increase, what do you think will happen to the coupon rate and yield rate in the market? Think of it. If government of India will start borrowing more and more money in the market, don't you think interest rates in the market will start increasing? Anybody has a problem with this? Interest rate will start increasing. Now, if interest rates will start increasing, you are a private sector company, you want to issue a bond, borrow from the bond market. Please tell me, will you be able to borrow at a lower cost of capital or a higher cost of capital? What will happen to your cost of funds? Will it start increasing or will it start decreasing? Don't you think your cost of funding will also start increasing? Arey Baba, some of you are saying lower. How? What is the logic? Please tell me, what is the logic? If the demand for money, if it is very difficult for you to comprehend, you are also demanding money, government is also demanding money. If demand for the money will increase, what should happen to interest rates? Simple logic. If the demand for the money increases, what should happen to the interest rates? The interest rate should increase. So can you borrow at a lower interest rate from the market? No, right? The marketing cost, that is the cost of funding for you, will start increasing. All of you okay with this? Now, don't you think because of this higher cost, because of this higher interest rate, many of the companies will simply say, right, I cannot afford this rate of interest, I will not borrow. Think of it. Right, many of these right will basically say, I will not be able to give you so much rate of interest, rather than borrowing, I will not borrow and invest. So can I call this as crowding out? Crowding out means moving away. Crowding in means moving towards. Crowding out is moving away. So because of a higher fiscal deficit of government of India, can I say private sector investment will be crowding out? Think of it. I'll repeat the statement. Because of higher fiscal deficit of government of India, there might be crowding out of the private sector investment. Next, tax net is very narrow. Lot of these companies are evading taxes, avoiding taxes.